Along with our economies being deeply intertwined, of course, many of our policies, whether we like it or not, are influenced by what happens in the United States. Stephen Poloz is with us now. Stephen was the ninth governor of the Bank of Canada, 2013 to 2020, and among many other things, including overseeing what was and remains a unique period in monetary policy history, became one of the first Western bankers, if not the first, Stephen, you can correct me, but to move to raise rates, to try to get back to normal at a time when Super Mario was still being Super Mario and other bankers were nowhere too close to raising them. So Stephen, I want to begin by thanking you for joining us with your wisdom and expertise. And I guess I want to start with, I'm not going to let you correct me. I'm going to let all that stand out there and say, you, of course, were there and responding to this global pandemic. And as the Lieutenant Governor said, nobody could have forecast that. There is no textbook. Your PhD did not prepare you for this. What do you think is the most important thing you learned, or that the bank learned, policymakers learned through that period?
Yeah, well, thanks, Amanda. It's great to be here. It's a fun day to participate in this conference. Obviously, we haven't written all the chapters of this story yet, but there are some things I guess we learned right away. I would say the first thing, right in the heat of the moment, was that central banks can do quite a lot to avoid financial crises. Most central banks acted very quickly with force. If you compare that back to 2008, it was much faster this time. Back in 2008, it was a little bit more sequential, kind of learning by doing. And so that allowed some of the stresses to build. And this time, I think it was pretty well preempted. And the second thing is that because we started all this close to the lower bound of interest rates, we knew all along that fiscal policy was going to be needed. But we also think of that in a technical way. And when it comes to the actual execution, politics really matters. Fiscal policy was never built for speed, for sure, but politics can keep your car in the shop for a very long time. While it gets negotiated or debated or what have you. And so I think the lesson of that is it's better for us to develop more enhanced, stronger, automatic fiscal tools so that they work without the debate. But bottom line for all that is good fiscal policy can avoid the need for negative interest rates, which I think is a good thing for everybody.
Well, let's get to that, because one of the things for sure, whether it was on the monetary side or the fiscal side, and that, this conversation continues, is action was taken. It was necessary. It was, to your point, fast and unquestioned, right? We knew it was an emergency. It had to be addressed. There wasn't a lot of sitting around and hand wringing about any of it. What is in your view, is there a limit to monetary policy? And I want to put that in the context of, you were talking about the need for fiscal policy before March 2020. You were talking about this months and months and months before that. Fiscal needs to step up. So is monetary policy, is there a limit to what it can do?
Well, there is, and we're very close to it. And what we were arguing before the crisis, before COVID came along, was that actually there's a whole second layer to policy discussions, which is the mix between fiscal and monetary policy. If you have a prolonged kind of soft patch for the economy, if fiscal policy does more of the work of giving the economy a lift, it takes some of the burden off monetary policy, and you can therefore have, on average, a higher rate of interest in the economy, which of course cuts off some of those stresses that we pick up, financial strains, bubbles, if you like, too hot of a housing market, those kinds of things. So the mix of policies can matter quite a lot all the time, not just during a crisis. And so I think that was the nature of the discussion there. Of course, it's doubled now, where we have monetary policy basically has done most of what it can deliver. We know there are other tools in the toolkit. Those tools deliver things. We've had experience with negative interest rates, for instance, and lots of QE. But really, all you're doing there is you're trying to squeeze a little more juice out of the lemon. You've done most of what you can do already. And so really, in this stage, fiscal policy is the primary tool. And that's not a new thing. Keynes wrote that in the 1930s, right? It's not some big insight.
I mean, what may be new, and still one could argue an experiment that's unfolding in real time, is this amount of stimulus on the monetary side. 10 plus years of stimulus on the monetary side with fiscal consequences. Fiscal policies have monetary policy consequences. Do you think there will be results here that could be negative in a way that we either haven't foreseen or that we're not prepared for?
Well, I mean, there are some basic things there that we need to keep in mind. First of all, monetary policy looks incredibly aggressive in this situation, but I think that only matches the profound nature of the crater that's in front of us in the economy. So if you're a major company under stress, and you've got credit lines with several important banks, your board was screaming at you in March and April to draw those credit lines, get the cash in the door so that we've got room to maneuver. Well, that influx of cash is like a precautionary demand for credit. And that demand is satisfied usually not through the system, because the system was pretty tight, kind of gummed up, as you know. So central banks are there doing repos and other transactions with banks, in effect providing that credit down through the pipelines. So that extra demand for cash is still there, it's still being satisfied. But as the economy goes back to a more normal setting, that angst will go down, and that money will come back through the system. Central bank balance sheets will shrink automatically. So a lot of that has a highly temporary nature to it. The QE, that's another matter. So QE is another matter where you're accumulating that large balance sheet, but in theory, that balance sheet can be any size as long as there is a corresponding element on the other side, government working balances, et cetera. And so the real question we have is sustainability of the fundamental debt that's being drawn down by governments. And that, of course, is something we have to understand better. We could be well over 100% of GDP by the end of next year, according to the IMF this morning. That's what they're monitoring for the major economies. Well, those are big numbers. We're just not experienced with that. And so, provided the interest rates stay low, and it looks like they probably would, it's more of a debt service issue, just like it is with a household. So in the end, I think a sustainability criterion can be met, provided that the government money is being used for productive reasons, productive purposes, and therefore it enhances the ability of the economy to grow through time and to pay off our situation.
But the $64 trillion question for both government and for homeowners is, will interest rates stay low? And obviously, we've experienced very low sustained rates. And unfortunately, you can argue we now have a generation of both politicians and homeowners who know nothing else. They know declining rates, really, as a state of being. They don't know rising rates or rates beyond the bank's control. Every time a journalist raises this question, you get kind of batted down as it's nothing to worry about. It seems to me, given what you just said, that it's something to worry about.
Yes, I think it's something we need to be investing lots of brain power into. And some of the old adages won't go away. But I think that interest rates, in real terms, interest rates are likely to stay low for probably a generation. This is basically a demographic effect. If you look at a 150-year chart on interest rates have been low almost forever, except in the 70s and the 60s, 70s, and 80s. And that's primarily the demographic boom that we had post-war that drove higher growth rates and higher demand for savings. But if we look, the rest of the time, they've been low. And I expect, because demographics are still slowing throughout the world, interest rates will stay low. But really what matters for debt service is the nominal rate of interest. And that, of course, brings us to what's the outlook for inflation? Because if inflation picks back up, then interest rates are going to pick back up. And so that hinges, of course, on demand and supply in the economy. Right now, we're very preoccupied with deflation risk, and as rightly so. But looking farther down the road, that hinges more on the question of the credibility of central banks, fiscal dominance, if that becomes an important factor, political interference with the inflation process. In addition, we have a number of things that are coming into the system that are more cost push. And so income supports, green taxation, those kinds of moves, deglobalization, those can all add to inflation at this stage of the cycle.
I'm curious whether you're surprised at the relative strength of the Canadian dollar, given everything, I mean, not just the debt levels you talk about, the prospects for our energy economy. Does it seem strange to you that we're holding where we're holding?
Not really. I mean, of course, I've always been one to give the market credit for getting it right, rather than to say, "Oh, that's wrong." You know that. But I think if we look out the window and ask, well, what is the whole idea? Think of that crater that has opened up because of COVID-19, and what central banks have done is basically to offset that deflation shock with a major inflation pulse. And so, out we go. And then we're supposed to be able to row our boats across that liquidity, across the crater. And once we get to the other side, then the crater can be drained again. Okay. But for the time being, they're doing the job right. And we can see the evidence in the stock market. We can see it in commodity markets. We can see it in the pickup in demand. So my sense is that the Canadian dollar is reflecting some of that, as, of course, our other commodity-based currencies. And don't forget, of course, an exchange rate is a relative price. And so when you talk about debt and all this aggression and the policies, well, everybody's doing that. And so does Canada still look like a pretty good place to be and to invest? Yes, it does. And so I think for all those reasons, we shouldn't be that surprised. In fact, when everybody has the shock together, you might expect, exchange rates to do some of the buffering. But in fact, they don't do that if the world manages to stay up there and commodities stay firm. That's exactly the same thing, by the way, that happened in the wake of 2008. China took off, and that boosted demand for commodities, and so Canadian dollar actually went up in that time period.
I am curious for your view of the Canadian housing market. And I guess feel free to kind of extend that back into your term. We've been worried about household indebtedness, about an asset price bubble. And various policy levers have been used to try to kind of rein it in. Today, as we sit here watching this extraordinary in those hot markets, not everywhere, but in those hot markets, strength and asset price moves, are you worried about housing?
Well, not really. I mean, I think if we get back to the nature of the recovery, by the way, I think the K shape is probably the best descriptor I've heard. And I don't even know who made that one up, but I saw Joe Biden use it, so it must be a good characterization, and it's being widely used. But the top part of the K has recovered well, as you know. Basically, that pertains to around 95% or a little more of the economy. The bottom part is where the damage is the greatest. It's around 5% or less of the economy. Of course, the airlines, retail, hospitality, business, tourism, that kind of thing. So we can have a long-term unemployment issue in those sectors, and eventually a supply side damage, right? So supply side damage. But along the way, that other 95% is what matters to how the economy will behave. And with interest rates at generational lows, you're bound to see a certain amount of heat in the housing market. We have months of pent-up demand coming through there. And of course, we're seeing the results of that combined with low interest rates now. We're supporting incomes so that it's not like people are doing it on a wing and a prayer. Even though the economy went down, income was supported. And so the real question is it sustainable on a debt side? And I've always argued that it probably was. Of course, that doesn't mean that the prudential policies shouldn't be continued, and make sure we keep that in check. But I think we have just as good a chance of growing out of this as we have on the fiscal side.
We do have a question from the audience that I want to bring in, because we are, of course, just a few weeks away from a U.S. election, and that may have an influence on what happens here in Canada, of course. Do you have a view of a Biden versus Trump presidency and how that affects recovery? And does anything worry you about U.S. politics right now? That last one's too big to answer in full, but give us the highlights. That
last one is too big to answer at all. But anyway, there's if uncertainty is an important driver for economic decision making, as it is through most of the business community, the certainty has never been quite this high. But I guess from that point of view, at least in a few weeks, that uncertainty should go down. Whichever direction it takes is an important question. But the main thing is that uncertainty can go down. But I think that between the economic policies that I've seen between Biden and Trump, they don't look like night and day difference. Okay, so there's a certain amount of trade policy would be perhaps calmer, more predictable, perhaps, but similar kind of intense. Regulatory policies, not too different, maybe a little more emphasis on climate. That's a good shift that could happen if it were Biden. But apart from that, I'm not seeing a huge difference in how the economy would behave. I think the economy is actually recovering better than most people thought, as is the Canadian economy. And that's precisely because policies have been excellent. And because one of the things, Amanda, that I'm going to go back a few years. You remember after 9/11, people said, economists said, oh, people will never travel again. Yep. They said that, and they said, therefore, we're going to have slow growth for a long time, And they never asked the simple question, I wonder what people will do with the money that they don't spend on travel. And so you ask yourself, what are people doing with the money today, now that they're not eating out, now that they're not taking that trip and all that sort of thing? Well, it's pretty clear they're doing the same thing they did back after 9/11. They're spending it on their home or buying a new place or what have you. So that's where the action is. And I guess it's possible there'll be long-term effects on, say, flight attendants or in restaurant workers. And those folks may need to eventually transition into doing renovations for your kitchen, because that's where the job growth is going to be for a while.
So, I mean, some of that kind of natural evolution, I think, will be upon us. I do want to talk about that when we talk about the K-shape. I mean, one thing that is distinct about this event is that the degree to which it hurt people was uneven, and the degree to which people are recovering will be uneven. And that happens on the overlay of the inequity we already saw. And it was an inequity that you played a part in, which was the savers versus the borrowers. Savers have been getting the short end of the stick for a good 10, 11 years here. That's not likely to change. And so that inequity is really only amplified. Should it be of more concern to us now? And are some of the policies we're seeing post-pandemic actually helping to address that?
Well, I think income distribution is a really important determinant of how the economy behaves. And therefore, it's a critical overlay to how we make these kinds of decisions. But I think of it as an overlay as opposed to a primary driver, and I'll tell you why. The reason is that, say we face a really bad patch in the economy. Well, the only tool we had was either cut interest rates or do fiscal policy, or hopefully both. Well, of course, when we cut interest rates, we're told, well, you're adding to inequality. Well, I think the most important driver of inequality is the economic cycle. And so if the economy is weak, it's the lower end of the income spectrum that gets hurt the most. And so if you're able to use your tools in order to mitigate that and bring up the economy so that those people are hurt less than they otherwise would be, then you've done the first layer of mitigation that you can do on income distribution. If the tool has a side effect, which people don't like, well, okay, but the primary is most important. If the surgeon says you need surgery to save your life, well, okay, but won't it hurt? Well, yes, it will, but that's a side effect. The main thing is we get the job done. So I think people lose sight a bit of that primary directive, which is there in order to stabilize the economy, and that is an important driver of this redistribution issue. Well, there's no question you're onto something, and the longer it goes on, the more important it will become, and therefore the more it becomes very important that the fiscal action that we take has that as part of its objective. And naturally, the things that have been done so far do. And so I think a lot is being done on that front. The outcome remains to be seen. We won't really know for probably a year or more, how we turn out.
We have a question from the audience that fits in with this because it goes to the generational question of imbalance and inequity, and what sort of efforts and policies should governments and central banks use to promote wealth generation for the millennial generation, which lags the boomers. Other than, the boomers will die and pass on an awful lot of money. Should there be more thought given to this generation, which really is getting certainly certain cohorts of it are really getting short shrift here?
I agree. And I think, well, as I said earlier, I think the most important criterion for governments is to ensure that the money that's going out the door is somehow contributing to the growth prospects of the economy, not just stabilizing the economy, but the long trend and growth. And that is productive infrastructure. And in there, I would include social infrastructure. And so, for instance, daycare, which sounds like, oh, that's really expensive. Well, that would be really expensive. Well, no, that's the kind of social infrastructure that can pay for itself. Because if you look at Quebec, how much they boosted labor force participation by women by having a very up-to-date kind of daycare system, whereas the rest of Canada has lagged that. And I think having those kinds of smarts about the policies will add a lot to your question about redistribution of income, stabilizing that, as well as adding to the growth trend of the economy long term. And that's how we will pay for all this.
I want to ask you, I think the surgery one is an apt one. Having said that, of course, surgeries can go too far. They can be overly aggressive. And with hindsight, you say, we might have only taken off the finger and not the whole arm. So just in terms of what you've seen, and then I'm going to ask you actually to take it back to your whole term, because we haven't talked since you left. But is there something you wish hadn't been done from a policy point of view, or that you would do differently with hindsight?
Not really at this stage, Amanda. I mean, I think, as I said earlier, I think the real lessons will have to be drawn when the episode's really over. At this stage, you might have thought there was overreaction on some fronts 3 months ago, but now that was back when we thought this might be over in 6 months. Now it's been 6 months and it's clearly not over. And so I think those kinds of judgments really can't be reached when we're still in the middle of it. So I think everything that we've done so far was essential, and maybe some things could have been done faster. It might have made a difference. As I said, politics kind of gets a little bit in the way, and if we had more automaticity to those fiscal drivers, that would have been a handy thing to be able to rely on. But that's about all I've got for today.
We are, of course, not out of the woods yet. We don't even see the daylight on the other side, where in terms of the path of the pandemic, lots of talk about resisting negative rates in this country, at least from a central bank policy point of view. What's your thought on that? Should we fall deep back into a pandemic with nowhere else to go? Is that where we go?
Well, it's not right for me to comment on actual issues that are under consideration or being analyzed at central banks today. But I mean, I think what we've learned about negative interest rates so far is that they've really only been deployed in cases where fiscal policy was failing to provide the solution. So in Europe in particular. And so in Europe, of course, they've made a big move there now. So we're going to have a bit of a fiscal reaction, or part of the policy toolkit. That's a big improvement, and that I think is going to be more effective than negative interest rates ever could be. But in theory, they all remain in the toolkit. And as I said before, there's a little extra juice in that lemon. You want all the juice you can get. If you're the last person standing, you've got to be doing your utmost. You can't say 2 years from now, well, I did everything well except try those negative interest rates. You've got to be able to say I did everything. And so I think that's kind of where I see it in theory. How central banks sort all that out, that's of course somebody else's job these days.